What's up everyone, it's Karthik with MoneyVest. So this is actually going to be quite an interesting video for a lot of math nerds, statistical nerds, because we are going to be covering volatility in this video. And I'm going to take it a little bit step further because in my previous videos, I've tried to keep things super simple and really just kind of help you understand that volatility is just one of the measures for the fear in the markets. And when the VIX is high, it is time to buy. When the VIX is low, it's time to go. But today we're going to take it a little bit step further. In fact, we're going to be going a lot of steps further into trying to understand what a normal market structure looks like from a volatility perspective and what a contango and a backwardation actually means and how to really identify opportunities in the market for us to better understand whether markets are starting to move back higher, whether volatility, we're really just going to be using volatility as a guide for market positioning. So hope you all enjoy this. Share this video with other traders, investors who can benefit from this information, and bear with me here if you don't fully understand what is going on. I'm going to be doing a lot of more educational videos on volatility. In fact, I'm actually working on a course around volatility. I've done videos on fundamental analysis, technical analysis, psychology, and options, and now we're going to be focusing more and more on volatility. So let's get started. These are my spreadsheet. As you know that I like to work with spreadsheets a lot, and I'm going to be going over all the data and everything in this video that you need to understand. So a lot of you guys are familiar with the regular VIX, right? So if you come over to our volatility, this is the volatility that we like to track. This is the 30-day implied volatility on the S&P 500 based on the options chain, one strip of options of the S&P 500, and it tracks the volatility, expected volatility on the S&P 500. And this is nothing but a percentage, right? So this is not USD actually, this is actually 24 percentile, and this is just telling us the expected move, 1 month implied move in the S&P 500 based on the market's options pricing. So if you come over to this right here is a Word doc, which we are going to go over together. So the volatility is essentially calculated based on a strip of S&P 500 options. The VIX measures within one standard deviation of the forward 1 year expected move in the S&P 500. And one of the things that I really want to mention and want to be very clear on is that volatility is not perfectly negatively correlated, meaning that there is no inverse correlation between volatility and the S&P 500. So just because the VIX is going high doesn't mean the S&P 500 is going to go down, and vice versa. Just because the VIX is coming down does not mean the S&P 500 is going to go up. The reason why there is a negative correlation to begin with, and if you take a look at the historical measures of volatility and S&P 500, there is a long-term rolling correlation between S&P and volatility of negative 69.7%. If you take a look at S&P and the QQQs, which we also have highlighted on our charts here. So if you come over to our spreadsheet, if you come over to VIX summary, you'll notice that we've essentially identified the correlation between VIX and QQQs. That's the NASDAQ index, which is negative 61.96%. So that's the number that we've already highlighted on our spreadsheet. And this is the negative correlation between the S&P 500 and volatility. So while there is a negative correlation, it is not perfect. So that means that 30% of the times volatility is moving in the same direction as the S&P 500. In fact, on shorter durations, on a 5-day basis, there is many times in the past we've seen volatility and S&P 500 move in the same direction. If they're both going up or they're both going down. So it doesn't have an upward or a downward bias. It is mostly directionless, okay? But the reason why there is a negative correlation, you might be asking still, is because most traders and investors hedge to the downside. So there's always an imbalance of put buys versus call buys. Because traders hedge to the downside to protect against a crash in the S&P 500 or a drawdown in the S&P 500, there is significant amount of buying for put options than there is to call options. When we are looking at that options strip for the S&P 500, there's always seemed to be a bit of an imbalance between put options and call options, thereby representing the negative correlation between S&P 500 and volatility. Now, a few more things that I want to really highlight here is that the VIX can stay high in an uptrending market. Many times in the past, we've seen S&P 500 continue to go up despite volatility being a little bit more elevated. And on the contrary, it can also stay low during a downtrending market. So it doesn't have to spike when the markets are coming down, right? So there is no bias, upward or downward bias between volatility and S&P 500. Yes, there is a negative correlation, and that's really what traders are betting on, right? So that's the probability of long-term correlation normalizing at negative 69.7%. It is also a percentage value. So like I said, it is not an actual USD value because you can trade the VIX. There's specific instruments and different products that you can trade to essentially trade volatility, but you can't really trade VIX in itself. It's just a percentage value that shows us and gives us the implied S&P 500 move plus or minus over 1 year. So as I said, that VIX 20 essentially represents, let's say for example, the VIX is at 20, that represents the S&P 500's move plus or minus, doesn't matter because it's directionless, of over 1 year of 20%. For different time frames, we need to do a certain calculation to take a square root of n, which is n meaning the time frame that we're trying to calculate for, to try to figure out what is the expected move in the S&P 500 based on the current VIX value. So for example, if you're trying to calculate the 1 month forward VIX value, you can take a square root of 12 because there's 12 months in a year, which is 3.46, and then you take the current VIX level of 20 in this example divided by 3.46, and now we get a plus minus 5.78% implied move in the S&P 500. Again, plus or minus because there is no direction. If you're trying to look at 1 week forward VIX value, square root of 52 because of 52 weeks in a year, and that's a 7.21, and 20 divided by 7.21, now we're looking at plus minus 2.77%. This right here is a chart calculating for different VIX values with the implied move on a 1 year, 1 month, 1 week, and 1 day basis. So to give you a little bit of an example right now, volatility right now is at 24.36 as of the time I'm recording this video. So if you come over, take a look at 24.36, we're right about 25 here. So that means there is about a 24.88% implied move in the S&P 500 plus or minus. In 1 month, 7%, 1 week, 3.45%, and 1 day is 1.5%. That's the implied move in the S&P 500 plus or minus is what the market is pricing in or expecting based on volatility. So that's a nice little cheat sheet that I've included here in this video that you can also take a look at for yourself. So now we come over to how to understand pullbacks, corrections, and crashes. And for that, I've also got another spreadsheet here that I'm going to break down. So what I've really done here is I've essentially taken into account the all-time highs for the market. So back on July 16th, we were at an all-time high for the S&P 500. So if you come back over to SPX, you'll notice that we pretty much were at all-time highs here on this candle on July 16th. So I've taken into account the VIX values at that moment in time. And then I've also accounted for the VIX values on Monday, August 5th. So those are the two comparisons that we're actually doing in this video to help you better understand. So if you come over here, July 16th, and I've essentially broken it down into 5 different VIX values. So this is the normal volatility that we look at, right? So if I point that out for you, you'll notice that this is indeed the volatility measure for us, which we track on a regular basis, which is the normal VIX. But people may not know that there's also short-term and long-term duration volatility. So we got a VIX 90, which is also available on TradingView. So this is our volatility watch list. If you come over to VIX 90, that's the 9-day volatility on S&P 500. And you can see that it actually spiked all the way up to 76, right? So it doesn't get a lot of attention. It doesn't get a lot of popularity, but it spiked up to over 76. Then we've also got a 3-month volatility. So VIX 3M spiked up to over 43. VIX 6M, which is 6-month volatility, and on the S&P, that's over 37. That was the high on Monday. And then the 1-year volatility, which is VIX 1Y, spiked to as much as 33. So what we have here are the values that we witnessed for all these 5 VIX futures on July 16th and then on August 5th as well. August 5th being the correction for the market. S&P 500 was down almost 10% from its all-time highs, and this is during all-time highs. So when you plot these on a chart, okay, when you plot these numbers on a simple line chart, what you get really is a normal market structure. So this right here is what the VIX structure looked like on 7/16, which is July 16th at an all-time high. This is a normal functioning market. This is an upward sloping curve where the longer you go out in terms of the time period, the higher the VIX value is, because in the future, nobody knows where volatility is going to be. Because there's so much uncertainty out in the future, traders expect volatility to be higher, okay? Because there's so much uncertainty. Nobody knows what the markets are going to be doing in 3 months or 6 months or 1 year. That's why volatility is higher, or is at least getting priced higher the longer you go out. And this is what's called Contango, okay? So if you come down, this is a normal market structure, upward sloping. Longer dated VIX futures are priced higher, also called Contango. And this is a normal functioning market. This is how it's supposed to be, similar to what we know for a yield curve: shorter duration, lower values; longer you go out, higher values. Now, the future is uncertain, so volatility is priced higher in the future. But what we witnessed on August 5th, which was Monday, and that's when volatility across the board spiked, the curve switched, because now you've got short-term volatility, 9 days at 42. That's the closing price. That's a closing percentage for these levels. The normal VIX closed actually at 38.56, even though it peaked at over 65, which we talked about on the channel, multiple times over. It closed at 38.56. The 3-month closed at 33, 6-month closed at 30, 1 year closed at 26. So you can see that it actually came down significantly. So this was an ascending chart. This should be a descending chart. So it actually flips to backwardation. And this is what backwardation looks like, because short end of the curve is extremely high at over 42. And the longer you go out in volatility, the lower the values are, because markets now starts pricing in that VIX is extremely high on a short-term basis. And as we go out, there's going to be a crush in volatility, and we're going to see this chart be downward sloping. So this is elevated fear structure, downward sloping, also called backwardation, and this is longer dated fixed futures are priced lower as you go further out in time. So really the idea for us to understand here, and I'm going to be covering this in our future videos, is to understand the chart, the line chart of volatility, and when it switches from backwardation to contango. Because if contango to backwardation is bearish, backwardation to contango is bullish. And that is just a way of understanding volatility and market positioning. So coming back over to our doc here, this is the VIX futures term structure as it stands right now. You can actually get this information from VIX Central. And this is not going as far as 1 year, but this is essentially going out as far as 9 months. So this is the next 9 months worth of VIX futures. And you'll notice that we've got August, September, October, November, December, Jan, February, and March. So this is going out as much as 8 to 9 months of volatility and how it's priced in the market. This is real dollars being bet on volatility down in the future. And you'll notice that a normal curve should really just look like this. This is the normal market structure. And this is exactly what it did look like back on July 16th. But after the specific spike here that we witnessed on Monday, after the carry trade, the recession fears, and then again, the volatility spiking so much, we are now starting to see this curve a little bit more become downward sloping with a few spikes here in October and November. And I'll explain that in just a minute. So first, let's try to calculate the difference between M1 and M2. I'm gonna explain what that M1 and M2 is. So each date represents a 30-day out expiration of VIX futures. In other words, where bulk of the traders are pricing in volatility for each month out. So that's each month out and where the bulk of the traders are pricing in for volatility to be. And green line shows us the current 30-day VIX reading, which is the current volatility here at 24. That's the current VIX reading. So if you come down, we don't have to guess, right? We can understand what real dollars are pricing in for volatility in the future. So calculation we need to do here is the difference between the first two VIX contracts, okay? And that is going to be right now as it stands, August and September. So if you come down a little bit, and then let's just say August contract is M1 and the September contract is M2, now we really have to understand the difference between these two numbers. Because ideally, as I showed you, in a normal functioning market, the shorter duration should be lower priced than the longer duration. So in other words, September contract should be priced higher than the August contract, right? That's an upward slope. Because as you're going further out in time, you're seeing the volatility also increase. Okay, that's the expected volatility from the markets. So if the shorter end of the curve is priced higher than the longer end of the curve, in other words, August futures are priced higher than the September futures, we're going to get a negative number. So if you take the September 21.8 subtracted by the August 22.35, you get the difference going out 1 month of negative 0.55. That's exactly what we have over here, negative 0.55. Now, the moment this number starts to turn positive, right, that is when we're going to see the backwardation starting to flip towards contango, where the curve is going to start to normalize a little bit. And really what we're waiting for is this curve to start becoming upward sloping again. And right now we do have October futures priced at 23. So the market's pricing in for volatility for the next couple months, August and September, to come down and then spike again in October to as much as 23. And for the right reasons. I mean, there's election coming up in November, seasonality wise, September, October tends to be pretty brutal months as what we have witnessed over the last 2 to 3 years here. So for the right reasons, we are expecting another VIX spike and then coming back down as it should, right now to 2120. But then what we're looking for really is the longer we go out, we start to see a bit more normalized VIX structure, which is upward sloping. So it's really just an understanding of bullish and bearish positioning of the market based on volatility. So as we go contango to backwardation, as we go from an upward sloping to a downward sloping curve for volatility, that tends to be a bearish signal for the market. And we also track the difference between these VIX futures, different term structures, and then also from backwardation to contango starts to become more bullish. And this is exactly what we're going to be waiting for from the markets for us to start repositioning more on the bullish side moving forward. So I know it can get a little bit more on the complicated side. I'm going to be doing a lot more videos and tutorials on volatility. And I'll be the first one to tell you, like, these are concepts that are extremely important to understand. And the sooner you understand, the better you understand them, the better you grasp these things, the easier it's going to be on yourself to better understand how to position yourself in markets, when and what asset classes to take advantage of. Because when volatility is high, it pays to be cautious. It pays to be alert, and it pays to be in safety rather than going crazy on these really, really high volatility spikes. So we're going to be doing more analysis and more updates on this. Hope you all enjoyed this video and found it a little bit helpful. As it stands right now, you can actually track the current VIX futures term structure on VIXCentral.com. 22.35 is the August futures with September price at 21.8. The difference is still negative, and we're looking for this number to turn actually positive. And then again, the overall curve to actually start being upward sloping like it was on July 16th for a normal functioning market, and for us to start going long and a little bit more aggressive once again. So hope you all enjoy this video and a complete update on volatility. Let me know your thoughts down in the comment section below. Market seems to be recovering a little bit, but we are seeing some downward trends on lower highs and lower lows on the NASDAQ and the S&P. So let me know your thoughts down in the comment section below. As always, happy investing. I'll see you all in the next feature.